The radio said diesel was up again. Not a lot, a few cents, but it was the third time in 6 weeks, and on a farm burning 4,000 gallons a season, a few cents adds up fast. The invoice on the kitchen table said $1.19 per gallon delivered. The one from March said 97 cents. Dale Hartman looked at that difference, did the math in his head, and felt the number land somewhere in his chest. Then he went outside and found his son, Gary, supervising 2 men with a flatbed truck who were unhooking the anchor bolts from the base of the first steel diesel tank behind the barn. Dale stopped walking. He didn't shout. He stood at the edge of the gravel and watched for a long moment. Gary. Gary turned around. "Dad, I was going to tell you tonight." "Tell me what exactly?" "I sold them, both tanks. Guy from Fairfield gave me $2,200 for the pair." He said it like a man who had solved something. "We needed the cash. Operating loans already drawn 60%, and we haven't started the back 40. That much was true. The operating loan at First Agricultural was drawn down further than it had been in any prior spring in Dale Hartman's memory. Input costs had been climbing for 2 years straight: seed, chemicals, parts, and now diesel was following. The farm's projected operating budget, submitted in January, had assumed $1.02 per gallon. That assumption was already wrong. Gary wasn't being reckless. He was reading the situation the same way most men his age were reading it in 1983. You look at what you can sell, you sell it, you buy yourself room. Steel tanks sitting behind the barn represented capital you could convert. If they were empty most of the year, they were just insurance you were paying for in terms of tied-up equity. Gary had done the arithmetic and concluded the farm didn't need storage capacity it wasn't using. The specific problem Dale already understood and Gary didn't yet, was that Gary had confused storage with price protection. Those are 2 different things. And in the spring of 1983, on a grain farm in central Illinois, that distinction was worth more than $2,000. The farm crisis of 1983 didn't announce itself cleanly. It came through accumulation. Land values that had peaked in 1981 were now dropping in ways that made a refinancing difficult. Commodity prices were soft. Corn, that had touched $3.40 a bushel in better years, was sitting closer to $2.80, and the futures boards weren't offering much comfort. Operating costs, meanwhile, hadn't followed crop prices down. They'd kept climbing. Diesel was part of that. Fertilizer was part of that. Parts and labor and interest on operating lines were all part of that. The squeeze wasn't dramatic. It was arithmetic. Revenue compressed from one direction, costs expanded from the other, and the margin between them, the number a farm actually lives on, got thinner every month. Banks across the Midwest were quietly renegotiating terms, calling in notes, reviewing collateral assumptions that had been written when land was worth twice what it was now. First, Agricultural had already sent Dale a letter in February, asking for an updated operating projection before the spring draw commenced. The letter was polite. The meaning behind it wasn't complicated. Gary understood all of this. He was 31 years old, had been working this farm for 9 years, and he was not naive about what the numbers meant. What he was doing with the tank sale was attempting to solve a liquidity problem. Short-term cash to reduce the draw on the operating line, free up room to finish the planting inputs, show the bank a cleaner balance on visible assets versus liabilities. $2,200 was real money in that context, but the tanks were gone by noon. The flatbed pulled out of the drive, and the 2 concrete anchor pads behind the barn sat empty. From that moment forward, every gallon of diesel the Hartman farm needed would be bought at whatever the going rate was on the day it was needed. Gary didn't think this was a problem. Prices would do what they did. You couldn't control that. You bought when you needed to buy. Dale thought about saying something that evening. He decided not to. Not because he was resigned to it, but because the situation wasn't finished yet. There was a document in the filing cabinet in the farm office that Gary apparently didn't know existed. Dale wanted to see how the next few weeks played out before he introduced it. Diesel kept moving. By the end of April, the delivered price in their county had touched $1.26. The Hartman operation needed fuel to run tillage, to run the planting equipment, to run the grain cart. Gary was calling the supplier every few days, watching the number, buying in partial loads when he thought it might dip. It didn't dip. It moved sideways for a week and then ticked up again. The neighbor, 2 sections over, a man named Preuss, who ran a similar-sized corn and soybean operation, called Gary one afternoon to compare notes. Preuss was paying $1.28. He was furious about it. His operating budget had assumed $1.05. The gap between assumption and reality was eating into his projected margin faster than falling corn prices had. He told Gary he was going back to the bank to ask for an extension on his operating line because the input cost overage was going to push him past his approved draw limit before the planting was finished. Gary hung up the phone and looked at his own fuel invoices. He wasn't in as bad a shape as Preuss yet, but the trajectory was clear. Every week this held or climbed was another few $100s in unplanned operating cost. In a year when margins were already thin enough to read a newspaper through, unplanned cost was not an abstraction. It was the difference between making a loan payment and calling the bank to explain why you couldn't. He went to Dale that evening with the invoices spread on the kitchen table. "We're about $900 over projection on fuel already," Gary said. "We've got the back 40 to plant and the bean ground after that." Dale looked at the invoices. He looked at his son. "What would you like to do about it?" "I don't know. Nothing I can do. Buy when we have to buy." "That's one approach." Gary looked up. "You have another one?" Dale got up from the table. He went to the farm office, which was really just a converted back bedroom with a metal desk, 2 filing cabinets, and a shelf of commodity almanacs going back to 1967. He came back with a manila folder and set it on top of the invoices. Gary opened it. Inside was a 2-page document on the letterhead of Meridian Ag Supply, dated November 14, 1982. It was a fixed-price fuel supply agreement. He read it once, quickly, and then read it again. "You locked in a price," Gary said. 99 cents a gallon, delivered for 12 months, valid through November of this year. Gary set the folder down. "When were you going to tell me this? I'm telling you now. I sold the tanks in April, Dad. I know you did." There was a pause. Not a dramatic one. Just the normal silence of 2 people working out the space between what happened and what it meant. Gary looked at the contract again. He looked at the invoices. The gap between 99 cents and 26 cents was 27 cents per gallon. Across 4,000 gallons for the season, that was just over $1,000 in savings, money that was still available to them because the contract was still valid. "Does this require us to have on-site storage?" Gary asked. That was the right question, and Dale had known it would eventually be the question. "No," Dale said. "Read page 2. Meridian delivers to the farm. The contract specifies delivery point, not storage method. What you have at your end, tanks, drums, nothing, that's not their concern. The price is locked at their end." Gary read page 2. This is the part that most people misunderstand about fixed-price fuel contracts, and it matters because the misunderstanding is expensive. A steel tank behind your barn is storage infrastructure. It gives you the ability to buy in volume, hold fuel on site, and pull from your own supply as needed. That has real value in terms of operational convenience. But storage doesn't control the price you paid to fill the tank. If you fill a 1,000-gallon tank at $1.26 and prices stay at $1.26, you haven't hedged anything. You've just pre-purchased at the market rate. A fixed-price supply contract does something different. It removes price risk from the transaction entirely. The supplier agrees to deliver fuel at a set price for the duration of the contract, regardless of what the market does. The buyer's exposure to diesel price volatility is eliminated for that period. It doesn't matter if the spot price rises to $1.40 or $1.50. The contract price holds. What Dale had done in November of 1982, when diesel was still closer to $0.95 and the direction of prices was already readable in the trade publications and the USDA input cost bulletins, was purchase price certainty. He'd traded the possibility of buying cheaper later for the guarantee of buying at a fixed number now. In a year when every other input cost was already unpredictable, locking down the fuel line was a structural decision, not a storage decision. The tanks Gary sold were useful for convenience. They were not the source of protection. The contract was. When Gary understood that distinction, fully, not just intellectually, something shifted in the way he looked at the folder on the table. Gary called Meridian the next morning to confirm the contract terms. He explained that the on-site storage tanks had been sold and asked whether delivery could continue to the farm address under the existing agreement. The Meridian rep, a man named Stoltz, who'd been handling agricultural accounts for 11 years, confirmed that the contract was fully valid. Delivery terms required standard access to the farm and a means of receiving fuel. A portable receiver or a temporary tank on skids would satisfy the delivery requirement. The price protection was not affected by the change in storage infrastructure. Stoltz also told Gary, without being asked, that 3 other farm accounts in the county had called him in the past 2 weeks wanting to establish fixed-price agreements. He'd had to tell them the current offered rate was $1.24, because that was what the market was doing now. He couldn't backdate a contract signed in November of the prior year. Some of those accounts were going to pay 30 cents more per gallon than the Hartman farm for the rest of the season. Gary thanked him and hung up. He thought about Bruce, calling 2 weeks ago in a controlled panic about his operating line. Bruce had built his fuel budget around the assumption of spot market purchasing. He'd made the same implicit choice Gary had made, just without the tank sale as a visible trigger. Both had assumed that fuel cost was something you managed by watching prices and buying when it seemed right. Neither had locked in a number when numbers were lockable. The difference was that Dale had locked in a number. Quietly, in November, without making a production of it, he'd signed 2 pages of paper that converted a variable cost into a fixed one. On a farm where commodity prices were out of your control, labor was semi-fixed, land costs were fixed, and equipment depreciation was fixed. The ability to fix one more major input wasn't a minor thing. It was the kind of structural move that changed how a year added up. Gary drove to town and picked up a 500-gallon skid tank from the co-op. $40 a day rental. He called Meridian and arranged delivery under the existing contract. The first load arrived 2 days later at 99 cents per gallon. By mid-May, diesel in their county was at $1.31. The Edge Extension Office published an input cost update, noting that diesel had risen 18% since January, and that farms without forward price agreements were running operating cost overages, averaging 4 to 7% of projected input budgets. That doesn't sound like much until you understand that the margin on corn at $2.80 a bushel, after input costs, land rent, and loan service, was already thin enough that a 4% overage on inputs could eliminate the profit on a 100-acre field entirely. Preuss went back to First Agricultural. So did two other operations in the township. The bank's loan officers were doing a lot of conversations that spring about operating line extensions, and none of those conversations were comfortable. When your projected input costs rise past your approved draw limit before you finished planting, you have a problem that doesn't fix itself by waiting for harvest. Dale went to First Agricultural too, but for a different reason. The bank had requested an updated operating projection in February, and Dale had submitted a revised one in late April once the planting season was underway. That projection now included the fuel contract as a line item, 99 cents per gallon delivered. Contract documentation attached. The loan officer, a woman named Carver, who had been reviewing Midwest farm accounts since 1976, looked at the projection carefully. She looked at the fuel contract documentation. She looked at the spot market price column Dale had pulled from the county extension bulletin. "You're paying 32 cents less than spot on every gallon," she said. "On 4,000 gallons for the season, that's about $1,280 saved against market rate." Carver ran the numbers through the operating projection. The fuel cost savings moved the projected margin on the Hartman operation from barely positive to comfortably above break-even, even with corn prices where they were. It wasn't a dramatic improvement. It wasn't the difference between solvency and failure. But it was measurable, it was documented, and it was real. "Your risk rating holds," Carver said. "I'll note the contract as a hedging instrument in the file." That last phrase, hedging instrument, is the correct term. A fixed-price supply contract is a hedge. It doesn't reduce the amount of fuel you need. It doesn't improve your crop yield. It doesn't fix the commodity price on the other side of the ledger. What it does is reduce the variance on one specific input cost, which reduces the variance in your operating margin, which reduces the uncertainty a lender has to account for when they're evaluating whether your farm is a workable credit risk. In 1983, reducing uncertainty was worth something concrete. Banks weren't being irrational when they tightened their review of farm accounts. They were looking at operations where multiple cost variables were moving in the wrong direction simultaneously and trying to determine which ones had enough structural stability to service their debt. Dale's farm had one more fixed line than most. That mattered. Gary didn't say much when Dale came home from the bank. He asked how it went. "Fine," Dale said. "Rating held, lines confirmed through harvest." Gary nodded. He was quiet for a while. Then he said, "The Preuss place is in trouble." "I heard." "He's a good farmer." "Yes, he is. Doesn't mean anything, does it, being good at it?" "It means something," Dale said, "but it doesn't substitute for structure. That exchange isn't a moral lesson, it's just accurate. In a commoditized agriculture environment, which is what Midwest grain farming is and was and will continue to be, the skill of the farmer has limited impact on the outcome. You can be meticulous about your agronomy, efficient in your field operations, careful about your equipment maintenance, and still get compressed by input cost inflation in a year when commodity prices don't compensate. The variable that survives a bad year isn't usually superior farming skill. It's cost structure that holds when prices don't cooperate. Dale had learned that over 30 years of running the farm. He hadn't learned it from a textbook. He'd learned it from watching which operations survived the bad cycles and which ones didn't. The ones that survived weren't always the best farmers. They were the ones who had more lines fixed and fewer lines floating when the bad cycle hit. The fuel contract was one fixed line. It was 99 cents a gallon for 4,000 gallons in a year when the market was paying 30 cents more. That's not a miracle. That's a contract signed in November when the price was right and the direction was readable. Gary thought about it that way for a while. He thought about the tank sale specifically. The $2,200 he generated had covered about a week of operating line draw. It had solved a visible problem, a balance that was high on a line he could see, by eliminating an asset he could see. He'd moved a number. What he hadn't seen was the contract in the filing cabinet that was doing something the tanks never could have done. The tanks, full, would have held 2,000 gallons. At the locked price of 99 cents, that inventory would have been valued at market. If diesel rose to $1.31, which it had, the stored fuel would represent an effective savings of $640 on 2,000 gallons. But you'd have to draw the line there. Once the tanks ran dry, you were buying at spot again. Storage is a buffer. It blunts the first impact of a price spike, but it doesn't protect your entire consumption for the season. The contract covered every gallon for 12 months. At 4,000 gallons, the savings over spot weren't $640. They were closer to $1,280. The contract had more than twice the financial impact of a full tank at the moment prices peaked. And, unlike storage, it didn't diminish as you consumed it. Every delivery, every fill, every gallon burned in the field during planting and tillage and cultivation, all of it came in at $0.99. You can't outstore a sustained price spike. If prices rise and stay high, your stored inventory runs out and you're exposed. The only thing that insulates you across a full season of consumption is a price you locked before the spike arrived. Cash tied up in steel tanks is liquidity. A fixed-price contract is leverage. They aren't the same instrument, and they don't do the same job. Gary understood this now in a way that was no longer theoretical. He understood it through invoices and margin calculations, and a trip to the co-op to rent a skid tank for $40 a day so Meridian could deliver under a contract his father had signed in November. The tanks were steel. The contract was the structure. By the end of the season, the Hartman farm had taken delivery of approximately 3,800 gallons under the fixed-price agreement. At the average spot market rate for the county that season, roughly $1.27 per gallon, the market cost of that fuel would have been $4,826. At the contract price of 99 cents per gallon, they paid $3,762. The difference was $1,064. That number doesn't include the skid tank rental cost, which ran about $1,200 over the season. The net fuel cost advantage was modest, somewhere near break-even on the direct comparison. Gary had sold the tanks for $2,200 and spent roughly $1,200 renting a substitute. So the tank sale netted around $1,000 after accounting for the rental against the roughly $1,000 fuel savings from the contract. But that arithmetic is the wrong way to look at it, and Gary knew it. The contract's value wasn't only in the fuel savings. It was in the projected margin stability that kept the bank's risk rating from moving. It was in the documented input cost certainty that gave the loan officer something fixed to work with when every other input line was floating. It was in the operating season completing without an emergency conversation about extending the draw limit. Those outcomes aren't easily quantified in a single number, but they were real, and they were consequences of structure that existed before the price spike arrived. Preuss got through the year too, barely. He took on a short-term note extension to cover the operating line overage and paid it back over 2 years. The farm survived. But the terms cost him, and the stress of the spring conversations with the bank were the kind that don't fully leave a person. Some operations in the county didn't get through. Not many, but some. The ones that didn't usually had multiple variables moving against them at once, with no fixed lines to absorb the compression. Diesel was rarely the only factor. But it was a real one, and in a year when margins were already thin, real factors had real consequences. Dale didn't say much about it after harvest. He wasn't the kind of man who needed to. He'd made a decision in November, kept it in the filing cabinet, and let the season prove its value without editorial comment. That's not stubbornness, and it's not withholding. That's the manner of a man who understood that financial decisions don't need to be argued about. They get documented, and then they either work or they don't. Gary's thinking had shifted, not dramatically, not with any particular moment of acknowledgement, but in the way a practical person's thinking shifts when evidence presents itself clearly. The tank sale had made sense as a liquidity move. He'd still make it, probably, knowing what he knew now, but he would make it differently. He would check the filing cabinet first. He would know what instruments were in place before he moved any assets. He would understand that the visible things on the farm, the equipment, the structures, the tanks, aren't always the primary source of protection. Sometimes the protection is in a folder in a metal filing cabinet, and it doesn't weigh anything, and you can't see it from the road. Steel rusts. Contracts don't. He'd heard his father say that once, years before, in a context he couldn't now remember. It had seemed like a general observation at the time. In the fall of 1983, it felt like the most precise piece of financial analysis he'd encountered in 9 years of farming. The bank confirmed the operating line renewal in October. The terms were the same as the prior year. The risk rating had held. The season closed. If you want to understand how Midwest farms made it through the hardest years, not through luck, not through exceptional talent, but through cost structure and contract discipline and the quiet decisions made in November when nobody was watching, there are more stories like this one. Subscribe if you want to hear them.